Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Manpreet, and welcome to Through the Noise. Now, there are decades when nothing happens, and there are weeks when decades happen. That's a quote many of us will be familiar with, but in some ways, recent weeks have felt a little bit like the proverbial weeks when big shifts start to happen. In the US, we know Trump continues to pursue his tariff agenda, but over in Europe, Germany has started down the path of much bigger fiscal spending programs. So, just how significant are these shifts, and how should investors think about them from the perspective of their portfolios? To discuss this and more, I'm joined by Audrey, head of asset allocation at our CIO office. So, welcome, Audrey. Thanks for joining us during a particularly interesting week. So, let's start with Europe. This week, more than two-thirds of lawmakers in Germany's outgoing lower house of parliament did vote to ease the government's constitutionally mandated debt limits. So what do you make of this historic vote? And in your view, what does it mean for European asset markets?
Well, hi, Manpreet. The move to ease German's government's constitutionally mandated debt limits, which basically restrict their annual budget deficits to around 0.35% of GDP, is indeed quite historic. And if the German fiscal plan is eventually approved by the upper house next week, it could signal a sharp turnaround in the country's tight-fisted fiscal policy, which they have adopted since the 2008 global financial crisis. Now, the proposed fiscal package is quite significant in a few ways, as it will enable first, defense spending exceeding more than 1% of the GDP to be released from the constitutional debt restrictions. And two, it will also create or encompass of an off-budget infrastructure fund that can borrow as much as 5 billion euros over the next 12 years. And then last but not least, it will also allow Germany's 16 states to borrow up to 0.35% of GDP instead of the existing mandate to run a balanced budget. So these measures could help to boost the economy's annual growth by around 2% and certainly improve the growth outlook for the European region as a whole, where long-term investors have written off the regions for years because of structurally slower growth, and hopefully encourage a reversal of global fund flow back to the region over the longer term. In the near term, though, we have got U.S. President Trump's proposed tariffs from the 2nd of April, and there are also parts of European equity markets which look a little overheated, which could present a short-term risk to the ongoing equity and euro currency rally. And the recent surge that we have seen in euro, as well as in terms of European bond yields, have also tightened financial conditions. So those are some of the risks in the short term. But having said that, we do believe that any short-term dips in European equities would create opportunities for long-term investors with little or no exposure to gain some exposure to the region in light of some of these structural shifts ongoing.
Thanks, Audrey. I think that covers the equity market implications. But I wanted to ask about bond markets because we have seen German yields rise with the fiscal approval, but also we had the Fed meeting. So, in your view, what's the outlook for U.S. bonds and the U.S. dollar, particularly after these moves?
So while for Europe, their long-term prospects looks to be improving, the US, on the other hand, it seems that risks are rising. And this week, the Fed has held his policy rates at 4.5% versus its long-term 3% target. And they have also cut growth and raised inflation estimates for this year as well. And these new projections implies some concern regarding inflation, perhaps due to President Trump's trade, fiscal, regulatory, as well as immigration policies. So while the Fed still expects to cut its policy rates by 50 basis points by year end, 8 out of 19 policymakers now see less than 50 basis points of rate cuts through this year. And in response to this, we have actually seen the 10-year US government bond yield decline to about 4.24%. And technical indicators suggest that the next key support level is around the 4.1% mark. So we maintain our expectations for yield to largely stay within the 4.25 to 4.5% range over the next 3 months. And we'll use any spike in yields to add to our bond exposure. And similarly, if we look at the US dollar index, the DXY, it is likely to remain in a consolidation phase. But having said that, technically, DXY looks a bit oversold, and the momentum indicators point to some upward pressure in the coming weeks. So we would expect the US dollar to edge towards resistance at its 200-day moving average of around 105. And then in the case of Europe, we see potential upside risk to bond yields, given likely German fiscal expansion. And in our opinion, this would compress the US Europe yield differentials and limiting the extent of any US dollar rebound.
Okay. Well, staying in Europe for a moment, the other key central bank meeting in recent days, of course, was the Swiss National Bank, which cut policy rates. What's your outlook for the Swiss franc in that context?
So the Swiss National Bank (SNB) cut its policy rates to 0.25%. That is largely expected. The central bank has also trimmed its economic growth forecast for 2025 from 1.5% to 1.4%, which is below its long-term average growth rate of around 1.8%. And they cited global trade tension as a risk factor. In the meantime, we've also seen Swiss inflation cooling to 0.3%, which is its lowest level in nearly 4 years, which basically prompted some dovish commentary from the SNB. So although money markets now see the latest rate cut as the last one for this year, our belief is the central bank may perhaps need to consider market intervention or even negative rates should the economy slows further. And technically, we see upside near-term risk for US dollar Swiss as the pair edges away from oversold territory, and a firm break above the point 8860 level is likely to result in a test of resistance towards its 100-day moving average, which is at the point 8950 level. And certainly, if we see downside risk aversion growth, then that may present downside risk to the pair.
All right, maybe shifting gears a little bit to gold. This is another asset class that has made a significant move, but now that prices are above $3,000, what's your outlook from here?
So year to date, gold has gained about 16%, which is its second best since 1980, and lag only the 18% gain that we saw in back in 2016 when the S&P 500 also saw a similar 10% decline in the first 2 months of the year. So after such rapid gains, we do feel that gold prices may look poised for a short-term pullback, and our diversity indicator has also now dropped below its 1.25 threshold, which basically indicates a higher risk of a reversal. So if we look at the spread between gold prices and its 200 days moving average, it has now hit 4 standard deviation, which is a level that has historically signaled a near-term pause in price. So having said that, any pullback we believe is likely to be mild, given that there are still the impending announcements of US reciprocal tariffs coming on the 2nd of April. That will keep uncertainty elevated, limiting potential downside in gold prices. In the meantime, from a demand perspective, global gold ETF holding continue to rise, indicating sustained investor demand, and central banks have also continued to add to their gold reserves. So as a result, we would use any near-term weakness in gold prices to add to our exposure, and the immediate support is seen at around 2950, followed by 2790.
Okay, and finally on equity markets, US semiconductor stocks have pulled back together with the pullback in broader US stocks. Do you see a buying opportunity amid this pullback?
So the technology sector, particularly semiconductor stocks, has been one of the worst performing sectors year to date. There was a large semiconductor industry conference which took place in the US over the past week. And from the commentary, industry leaders continue to see strong demand for semiconductor chips to meet computational needs. And AI models such as DeepSeek are believed to still require significant computation power as they spend more time thinking about a problem before delivering an answer. The market, however, remains relatively cautious on longer term demand, given that the industry continues to innovate very rapidly. And at the same time, semiconductor companies are also facing uncertainty with regards to trade tariffs, trade wars, with a potential escalation in US export restrictions posing risks to their revenue. So within the technology space, we believe that software subsector may offer a more attractive buying opportunity. Software has basically lagged the overall US market as well as the broader technology sector over the past year. However, the nature of their revenue is generally more steady and also more recurring in nature, which will make it less vulnerable to a risk of a trade war escalation. And AI developments can also lower the operating costs for software platforms, enabling them to enhance product offerings, and sector valuations also remain quite reasonable in our view.
All right, I think that brings us to the end of the time we have available today. So we'll bring the conversation to an end. Thanks so much, Audrey, for taking the time to speak to our listeners today. If I can summarize the top takeaways from our conversation, number one, of course, is we'd buy gold on dips, which we do expect to be relatively shallow. Second is that if you have little to no exposure to euro area equities, then we'd consider adding on pullbacks. And finally, of course, in the US technology software sector may be a tactical opportunity. So, thanks very much, listeners, for taking the time to dial into the conversation today. We hope you enjoyed the podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.